focus on what is call option and what is put option. What is like different between this both? We are just going to see. Uh, you know, like in previous video also I just explained, but now let me go with a little deeper. So in call option, you know, like if you're like for example, if you are a option buyer, then you are just going to give a rights or the right to buy the underlying asset with the strike price whatever you're going to choose. So option sellers are like, they are kingmakers in the sense they are just going to be, be the owner. But as an option buyer, you're just going to play with the contract, that assuming that this price can reach this level or that level. So that's what, like, as a buyer view, as a buyer, what you will think is, if you're focusing on option buying, like call options, then your full focus would be bullish. Okay, just leave the option sellers, because option sellers are the kingmakers. As I told you, at the end they are going to be in profits, but their profits are limited. But option buyers, because a lot of people will do option buying, so for you I'm just like kept a small brief through. You will focus on bullish, and as a put option you will focus on bearish. And as like sellers market, like as a seller view, as an option seller, if I'm like investing my money on call options, my view is going to be bearish or neutral. It should not move in upward, or it should not like move in what the option buyers are thinking. It should move against that. If it moves against option buying, as an option seller I will be in profit. Okay, so that's what. So in put option sellers focus would be like bullish or neutral. It should stay on the same place, so that they won't be achieve what they need, so that all the premium what they paid, it's for me. So that's what the mindset, and that's what option sellers would be. And buyers will make profit when underlying asset will be rising. When you go with the call options, underlying asset will be like like for example making profit when in put option when the market is falling down. So that's what the difference between call and put, if you as an option buyer. And option buyers maximum loss, how much the premium you paid. For example, as I told you, you just paid as a buyer, let me assume that, as I told you before, let me assume. So as a option buyer, what you will do, you will be buying like $5 with 100 shares, which is considered as one contract, which will be $500. So that's the maximum amount you're going to lose, like $500. But option sellers are not like that. They have to pay the full price. For example, if the current price is $100 for the each stock, they have to pay 100 into 100, which is like almost $10,000. So almost $10,000. So what will happen is they are going to lose 10,000, or if the market is going against them, they can even lose more than that. So that's the problem in option selling. In option selling, your loss is unlimited. So that's what I just given. Buyer's maximum loss is like the premium what you paid. Okay, and the buyer's maximum profit. For example, let me go with the profit statement. So making profit as an option buyer and option seller. So for option buyer, your profit is maximum. There is no limit. You can make 100%, 200%, 1,000, 10,000. There is no limit. You can make unlimited profit as an option buyer. But as an option seller, you can make profit. For example, you just paid 10,000 rupee, like $10,000, right? So $10,000 or rupees or real or whatever the rupee like currency you are holding, you're just going to pay that as an option seller. But as a return, you're just going to make only profit of $500. You can ask me why $500, but as an option buyer, he is having capacity to make $10,000. There is a chance to make $10,000 if the market is moving on their direction. But option sellers, they have only option is making $500. They can't make more than this, because whatever the premium they paid, only that much you're going to be making money as an option seller. So for option sellers, your profit is limited. As an option buyer, your profit is unlimited. You got the point. So that's all very easy. So that's all here I just given. And the break even at the strike price would be like, the strike price plus the premium paid. And for option call, if you go with the call option, in the option put, like strike price minus the premium paid, so that's would be the expiry settlement would be happening. Okay, you got my point. So this all you need to understand. And here I just given an example. So buy $100 of call with the $5, which is like profit if the stock moves 105 at the expiry day. Like for example, how I can say. So for example, let me go within. For example, I'm just saying. For example, let me go with an option buyer, option seller. So here what is happening is I just invested $100 and the current price, let me assume current price is $100. So what I'm just going to do is for example, if the market is moved in your direction, let's go assume that you just have a call options and the price has been moved $105. What will happen is you have invested $500 here, you have invested $10K here. Okay, don't confuse with the investment. So you just assume that you just have a contract of $105. So that's the contract you just bought it. Okay, $105. Again, I'm saying $105. Strike price you just added, and the market went to like for example like 110, or you just have a strike price. Just assume like you just have a strike price of $100 as a strike price, so that you won't get confused. When the market is moved in your direction and it went to $105, what will happen is you will have like for example with your $500 will be like for example you just have an 100 contract which is moved $5, extra $5. What will happen is your money will be doubled. Like you will be having $1,000 in your wallet. Got my point? I'm not going to I'm not confusing you. I'm just making you to understand even more clearly. You just invested $500 and with the $100 of strike price, if the $100 moves to $505, your profit like could be extra $500. How it happened, how you make 100% profit is you're paid $5 as in like here I just given as an example. Okay, so here I just given as an example, you just given $5 per share with 100 shares for one contract, which is like $100 you pay. So for one contract you just paid $5 with $100 with 100 stock you just bought, which is nothing but for one contract is equal to 100 stocks. So if the market moves $5, you would be like maximum profit of 1K. So with the the tax and everything and all, it's secondary, like time decay, delta value, a lot of things are there, but I'm just giving a small example for you to understand. But as an option seller, you would be made $500 of loss. So you would be having an like final balance of $9,500 as a balance. So this how it will be going. If this one is facing, this one will go. This one is facing, this one will go. But if the market is moving, for example, let's assume if for example, if the market has been moved like around from $100 to $120, just imagine $120, option buyer, option seller, you just invested $500, here you just invested $10K, because as a seller you are like a owner. Okay, so here what happened is market has been moved from 100 to 120, which is almost $15 has been moved. So what you have to do is you have to multiply 100 into 15, which like you will be getting like almost $1,500. So your profit alone would be $1,500. So totally you will have $2,000. But here you will have $2,000 minus. So totally you have $8,000 as the wallet. If the market is going on your opposite, your loss would be maximum. But if the market and go in your direction as an option buyer, your profit is maximum. You won't even imagine. Your capital will be double, triple very easily. This is how the option is working. This is how like a lot of people would show their portfolio with 100%, 200%, 500% profit is. This is what is happening. Same time you can ask me, what if happen if anything goes wrong? See, as the option seller and option buyer loss, what will happen as a loss? For example, you just bought a strike price with $100 with a call options, okay, and the market went to $95. Let's assume market went to $95, and you just assume like you just invested a 10k. Here you just invested 500. What will happen is your full money will come to zero. Just $5 pullback. $5 pullback, your full money will be coming to zero. Here you will be making $500. So this how the things will work. Everything will be talking on the expiry date. So I think you got understood how the options will work. In that, lot of things are there, time decay, lot of things are there. We are just going to discuss everything on the upcoming videos. Okay, let's see on the next video.